Here's a brutal truth most investors never hear. Over the past century, almost all the net wealth created by the US stock market came from just 3.44% of companies. That's it. And the top 0.26%, a tiny handful of giants, swallowed half of that wealth. Half. So here's the uncomfortable way to say it. Most companies on the market, they're basically working for the giants. Not competing with them, working for them. And economists actually have a name for this. They call it the Matthew effect. The name? It comes straight out of the Bible. For to everyone who has, more will be given. But from the one who has not, even what he has will be taken away. 2,000 years later, that one line still runs Wall Street like an operating system. But why does it happen? It's not luck. It's not just momentum. It's closer to physics. Here are the 6 engines underneath. Engine 1, positive feedback. Here's the beautiful part. Win once, and the win itself makes the next win easier. Think about a top venture fund. It gets the best deals because of its reputation. Those deals win. The reputation grows, and round it goes. Engine 2. Preferential attachment. Here's the idea. In any network, new nodes connect to the biggest hubs. That's just how networks work. New users, new data, new money. They all flow to whoever is already big. And that flow is the moat. Engine 3. Search complementarity. Here's how it works. The most productive companies pay top dollar to find the best people and the best suppliers. But here's the beautiful part. The best people and suppliers come looking for them. So a tiny productivity gap doesn't stay tiny. It gets stretched into a market share canyon. Engine 4. Monopsony power. Here's what that means. The giants become the buyer, the one buyer everyone has to sell to. And yeah, that includes workers. So watch how this plays out. They hire great talent at a discount. They keep the extra value for themselves, and then they pour it right back into R&D and acquisitions. Engine 5. Passive investing. This is the mechanical accelerator. Every time money flows into an index fund, and I mean every time, the biggest companies automatically get the biggest slice. No judgment call, no debate. It just happens. Bigger market cap, more passive buying, higher price. Bigger market cap, a loop that never, not once, asks about fundamentals. Engine 6. The sacred spark. Here's the deal. Top talent chases reputation and compute power. So, where do they go? They join the already famous institutions. And that means innovation concentrates at the top, even harder. Put all 6 together, and you don't get a bell curve. You get a power law. A few monsters take almost everything. Now, I know what you're thinking. Go ahead, say it. What about Nokia? What about the small cap premium? Doesn't that prove the giants can lose? So, the Matthew effect sounds unbeatable. But you've probably got 3 objections brewing right now. Good. Let's take them one at a time. Myth 1. Nokia died, so the Matthew effect failed. Actually, no. Nokia didn't break the effect. It proved the throne changes owners. Nokia clung to Symbian and cut itself off from the global developer network. Apple built the App Store and became the new hub. The company died. The effect got stronger. Kings fall. The crown survives. Myth number 2. But the textbooks say small caps outperform. Yeah, that was true decades ago. Today, the small cap premium has largely faded. Now, look inside the Russell 2000. Nearly a third of those companies are losing money on earnings. Zombie firms. Meanwhile, almost all the excess return in the entire market is being vacuumed up by a handful of giants. You know their names. The Magnificent Seven. Myth 3. If this effect is so powerful, why doesn't it work on human height? Great question. Because the answer unlocks everything. Here's the key. Height follows a normal distribution because there is no feedback loop. Think about it. You growing to 7 feet doesn't steal height from anyone else. Nobody loses an inch. No interaction, no compounding, no power law. The Matthew effect only lives in systems where players interact, where advantages pile on top of themselves. Markets, networks, not biology. So the effect is real. And it is not going anywhere. But here's where it gets darker. Nature built the engine. Then Washington came along and bolted on a turbocharger. The institutional amplifier. How lobbying turned regulation into the giant's strongest moat. Here's the part they don't teach you in finance class. Network effects are the natural engine of the Matthew effect. But America's political and legal system, that's the turbocharger. Here's how the loop works. The giants pour money into lobbying and through the revolving door. In return, they get complex regulations, compliance rules, data security requirements, mountains of paperwork. And here's the twist. Those very same rules become the giant's strongest moat. Look at the numbers. Only about 10% of top US public companies lobby directly. But once they start, 92% are still lobbying the next year. Why? Because it pays insanely well. Now, for a company with tens of billions in revenue, a few $1 million of compliance cost? Pocket change. But for a startup, it's a death sentence. The rulebook that was supposed to restrain the giants ends up protecting them. And the return on investment? Staggering. Research shows that for every dollar Boeing spent on lobbying, it got back about $7,250 in tax breaks. Lockheed Martin? They turned lobbying into $90 billion of government contracts. Now, show me an R&D budget with that kind of ROI. I'll wait. Then there's the money system itself. When the Fed holds rates low, the giants borrow at almost zero. And what do they do with all that cheap cash? They buy up the challengers before they ever become threats. Meanwhile, weaker labor protections let those same giants flex their monopsony power, keeping even more of the value their workers create. Money writes the rules. The rules protect the money. A closed loop. And you're not inside it. So the game tilts toward the giants. Does that mean you just buy the biggest companies and chill? Not so fast. Big doesn't always mean dominant. I'll hand you the exact screening framework to find the real Matthew entities and dodge the imposters. All right, let's get practical. How do you actually find a true Matthew entity? Because here's the trap. Big doesn't mean dominant. Some giants, just bloated. And some small companies, future hubs in disguise. So we scan on 3 dimensions. Dimension 1, the quantitative screen. 3 financial fingerprints. First, ROIC, return on invested capital, above 20%. Normal companies? They watch their returns decay as they grow. A true Matthew entity compounds its own capital. No cheap outside money. Second, margins. Gross margin above 80%. EBITDA margin above 40%. That is extreme pricing power, the kind that laughs at price wars. Third, free cash flow margin above 30%. That's the war chest. In a downturn, these companies don't bleed. They go shopping. Dimension 2, the qualitative check. Is this company a structural hub? Look for two-way network effects. Every new user, every new developer makes the whole network more valuable. Think operating systems, compute ecosystems, payment networks. And look for brutal switching costs. Products so deep inside a customer's workflow that leaving would hurt. Here's the tell. The best talent and partners are actively trying to connect with this company. Dimension 3, the moat stress test. VRIOM. 4 questions. That's it. 4. Question 1. Value. Does the resource lock users in? Not attract them, lock them in. Question 2. Rarity. Does it control the entry point everyone must pass through? Everyone. Question 3. Imitability. Is there a path dependency here that money and code simply can't copy? Think about that one. And question 4. Organization. Does information flow honestly inside the company? Honestly. That word does a lot of work. Because that's what killed Nokia. Not the iPhone. Run a company through all 3 dimensions, and you'll know exactly what you're holding. A compounding machine. Or a pretender. Now, the fun part. How do you turn this into an actual portfolio? The 3-step action plan. All right. Let's land this plane. You know what the Matthew effect is. You know why it can't be stopped. You know how to spot the real winners. So now, the playbook. 3 steps. Step 1. The quantitative filter. Open your stock screener. Filter for ROIC above 20% and free cash flow margin above 20% for 5 straight years. That one move wipes out over 95% of the market. The mediocre thousands? Gone. Step 2. Hub positioning. Here's the move. From what's left, you cut the commodity players, the companies selling interchangeable products, fighting it out on price. They're gone. What you keep are the ones controlling an ecosystem or a piece of industry infrastructure. The hub nodes. The toll booths. Step 3. Hunt for quality at a discount. Now, here's the counterintuitive gem. Sometimes a smaller company has Matthew-level economics, ROIC above 20%, but its stock gets crushed anyway. Why? Just because the whole small-cap index is down. That is a rare Matthew candidate on sale. And that is exactly where the excess returns hide. One last thing. Stop bottom fishing junk stocks and praying for mean reversion. That game is over. A century of data is brutally clear. Almost all the wealth comes from very few companies. The market is a self-reinforcing machine, so learn the rules, drop the mediocre, own the supernodes. That's how you stay undefeated. If this series changed how you see the market, hit subscribe and share it with one friend, the one who still believes in buying the dip on anything. You know exactly who I'm talking about. Because remember, to everyone who has, more will be given. So make absolutely sure, you own the ones who have.